Hey guys, welcome back. And today we'll be looking at financial instruments. We'll be just looking at net two questions. The first one will be on financial liability, and the second one will be compound financial instrument, meaning the one that has equity element and debt element. So now let's start with this one. So we are required to show how the value of debt changes over its life. Now, a loan note is issued at 1,000 Maluti. Debt is redeemable at 1,250 Maluti. The term of debt is 5 years, and interest is paid at 5.9% per annum. So this is the interest that is going to be paid, and then the effective interest is 10%. So effective interest is the one that is going to come here in our finance cost and go to the income statement. So with financial liabilities, as we remember, initially we'll be measuring them at fair value, then subsequently we hold them at amortized cost. So now we already have amortized cost schedule. Let's just punch in the formulas here because finance cost is going to be 10% of the opening balance, so we might as well punch it. Then closing balance, okay, yeah, this. So we're starting with 1,000 Maluti. So now how much is going to be our interest paid? It's going to be 5.9% of 1,000. 5.9% should be 0.059. So it's 59. Now the opening for year 2 is the closing for year 1. Now still power 59. Opening for year 3 should be closing for year 2. Then we still have our 59. Opening year 4, closing year 3. Then we still have our 59. Opening year 5 is the closing for year 4. And now here, in the final year, we are going to redeem it 1,250. Then plus the 59 for this year. So at the end, our debt is cleared. We don't have anything. So now let's see our effective interest. So they are up to how much? 545. Now let's just see when we make like this. So it's 1250. Then also is 59 by 5 years. Then the costs were 1,000. So let's just see some of these. Yep, is the 545, which is the effective interest, just as we have it here. So the finance cost is what will go to our profit and loss. Then this one will be the cash flows. Then at the end of each year for financial position, we'll be having the carrying amount of our liability as follows. So I believe that was straightforward enough for a pure financial liability. Now let's go on to compound financial instrument. So when I'm talking about the compound financial instrument, is the one that has the qualities of debt and the qualities of equity. It can be converted. So now we have DEF Ltd issues a convertible loan that attracts interest as 2%. The market rate is 8%. With the interest rate for an equivalent debt without the conversion option. The loan of 5 million is repayable in full after 3 years or convertible to equity. Discount factors are as follows. So with the compound financial instrument, the very first step is to split into its equity element and into its debt element. Then the debt element subsequently will measure it using amortized cost. So to get the debt element, of course, to get the debt element, we will to get the debt element, we'll get the present value of our future cash flows discounted at the rate assuming non-conversion. So next 2%, so 5 million, then 0.2%, so is 100. So now we have our level of precision as 1000 here. So in the first year is going to be 100, second year 100. In the first year is going to be the 100, then plus the 5 million. So should be 5.1. No? So discount factor straightforward 0.926, 0.857, 0.794. Then present value, of course, we're just punching in the numbers. We just punch in the numbers. So let's see. So this is our liability. This is our liability or debt. Debt pushing. Then our cash inflow is 5 million. So the equity element is going to be the balance. So that is 5,000. So this is going to be our equity element, which will go to other components of equity. So now the first step, we've done the first step, we've splitted this into the debt and the equity element. So now we have to account for the debt element. So for the debt element, let's see, finance cost, effective interest is 8% here. And closing, okay. So it's 42.28 the opening. Then we have our finance cost. Then interest paid. Let's see the interest paid. How much is our interest paid? Let's go to the interest paid. Oh, sorry for loss of connection a bit there. We were just here. Interest paid. Interest is 100. So yeah. So at the end of year one, we have this is closing. So now is going to be the opening for year two. Of course is 100. So for year three, the opening is going to be this as well. And then of course we still have 100. So you see the closing balance at the end is still 5 million, just the smaller rounding difference here. But it should be our 5 million as we saw here. Yeah, the loan of 5 million is repayable in full after 3 years or convertible into equity. So at the end of your 3 years, then you will make a decision. So I think you're comfortable with how we have dealt with this. The first step being splitting this into its debt and the equity portion, then subsequently accounting for the debt portion as we've done. And then cost, then we have interest paid, then we have the closing. So then from there it should be fine.